Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Markets move to the extent of their belief on the guidance provided. Let's take this for example. The entire rate cut conversation by Fed members in December led to a big rally in risk assets. But now the commentary seems to have changed with recent Fed members talking about rate cuts more cautiously. In the face of geopolitical risk, possible supply chain disruptions, and the strong underlying economy, it might cause doubts into this conversation. JK, you continuously track data from the US economy. What do you think would be the signs that would give markets a little more comfort about the US rate cut conversation?
Good morning, Swaraj. Definitely, I'm looking forward to the PCE number end of the month. Last month, it came weaker. I would say softer than expected. And that is what Fed is also tracking very closely. And it comes quite close to the Fed meeting on January 31st. So that could swing the rate cut expectations from the Fed, either way. As of now, the expectation of rate cut in March has slipped to 51%, and that's quite a drop. And there have been some factors behind that. Following a hotter than expected retail sales data on Wednesday, which confirmed strong consumption in the US, jobless claims data yesterday showed a steep drop to 1,87,000 from 2,05,000 forecast. And that's the lowest number since September 2022. And the continuing claims also collapsed to 1.806 million versus 1.84 million. That was forecast. So it's a very strong number. But something to take note of is that the survey data is generally very volatile towards the end of the year. Although, there is also another factor that, the jobs report that comes around January can also be volatile because of this number. Now, when you read this number along with the other indications in the ISM survey, etc., employment is not so strong. So it's really something that I would wait for January, or rather the claims in the coming weeks, and also the February payroll report before we conclude whether the job market has really turned itself very strongly. Now, the jobs number, in any case, provided an impetus to move in the yields, particularly in the longer end, that is the 10-year and the 30-year. 2-year, of course, remained unchanged almost. Now, apart from the job number, we had Bostic, the Fed member, saying premature rate cuts could unleash a surge in demand that could create upward pressure on prices. We should allow events to continue to unfold before beginning the process of normalizing the policy. And also because he is data dependent and incorporates the expected progress on inflation and economic activity into his outlook, he has moved his projected time of normalizing Fed funds rate to third quarter of this year from fourth quarter. So basically, he's still I would say, way behind what the market is expecting, and that's really what the market has taken note of. And I think more or less, given the current market expectations, March rate cut is almost ruled out unless the PCE number swings it favorably in that direction. Apart from these, we also had the ECB minutes that showed that the bank was still far away from discussing rate cuts. In fact, ECB has not given forward guidance like Fed did with their dot plot. And the European Central Bank is actually more cautious about growth outlook, but far from relaxed about inflation. And ECB, of course, had earlier been ignoring the structural weakness in the Eurozone economy, but in the December meeting, they seem to have changed as the staff projections have incorporated a lower estimate for potential Eurozone growth. But what comes about in this is that ECB is still not discussing rate cuts or keeping it on the horizon, fearing about renewed inflationary pressures, although their growth outlook is quite weak. Now, Japan, somewhat balancing these hawkish developments, Japan inflation has cooled for second month, as per data that was published today. and it has decelerated in line with the expectations, providing Bank of Japan with another reason to wait beyond next week's board meeting before they can end the negative interest rate policy. And the headline inflation rate has hit the lowest level since June 2020, cooling to 2.6% from 2.8%. And the core inflation rate has also decreased from 2.5% to 2.3%. There is also a data that shows that Japanese investments abroad has soared to 1.65 trillion yen from earlier 545 billion. So clearly, Japan is giving the risk sentiment all that it needs to be, afloat. So that's the reason why we have seen a strong move in the risk assets once again in the Asian market. Of course, taken cues from the US market, where we have seen all the major indices rise. Dow up 0.5%, S&P 0.8%, and the Nasdaq 1.35%. And the stocks have gained strongly, ignoring the expectation of, revised expectation of rate cut, but latching on to the strong retail sales and also fresh focus on AI optimism. So even the Chinese market has been somewhat positive. So we are starting the last day of the week on a positive note as far as the risks are concerned. As far as the yields are concerned, they have been trading at the highs well above the lows that was seen in the month of December. The twos are almost 30 basis points higher. The yields in Germany and UK are also higher. So it's a mixed bag. But then if you look at the yield picture at the beginning of December and where it is now, we are still much lower. And therefore, that's the reason why market is not too much concerned. A rate cut, even if it does not happen in March, it is not going to be a major disappointment for the market, because they feel that Fed is much closer to cutting rates this year, at least in May. And there will be a series of rate cuts. That's what the market still believes, up to 140 basis points. So on the Indian side, again, back to undesired, a very narrow range market that we've seen yesterday. And of course, this had some reason. We had almost 2.2 billion of foreign fund outflows due to sell-off in the stock market. At the same time, it seems to be matched with the corporate bond inflows, as well as some inflows into the bond market as well. That is, foreigner investment in bond market has somewhat balanced these outflows. That's the reason why we have seen rupee being capped, or rather the USD INR being capped at 83.20, despite the big sell-off of nearly 4% in the stock market, and also the foreign fund outflows. Some sporadic selling was also seen from nationalized banks, but the more it gets capped at 83.20 and the risk sentiment improving, there are chances that the dollar rupee starts to move once again towards 83 or slightly lower, as the outflows diminish, and also we have some steady inflows from the market. Overall, upbeat sentiment in the global market also helps. Thank you.
Thank you, JK. And last day of the week definitely started on a positive note, with equities having a positive day. Now the probability of a US rate cut in March has moved close to a coin toss. Jobless claim seems to be showing a stronger labor market, while ISM survey seems to be showing a weaker labor market. So of course, more incoming data would need to be analyzed. And Fed members have started warning of premature easing, which might unleash second inflation wave. So that's an important thought process to follow. For rupee, we followed a narrow range yesterday with balanced flows. FI selling along with bond inflows seem to have kept USD INR in a narrow range. That's it from us today. Thanks for listening. Tune in on Monday for the latest in the financial markets.